Michael, welcome to Validated.
Thank you very much for having me, Austin.
Yeah, good to have you here. So you are one of the core contributors to Marinade, which is, I think, the oldest, if not one of the oldest, if not the oldest, stake pool and liquid staking operations on Solana. So there's a ton that's changed. You guys launched a while ago. I'd love to hear a bit about what that was like, what got the project started. And then, we've seen the landscape change pretty dramatically since then. So there's a whole bunch of stuff we can get into today. I want to talk about institutions, ETFs, exit queues, all of the sort of components of both liquid staking and the non-liquid staking stuff you guys do that I think is of interest to a lot of people on Wall Street nowadays.
Makes sense. Let's get to it.
Let's start with the origins.
Well, for sure. So we started back in Solana in February 21. And before Solana, actually, I think I would date it back to 2020 when I was playing with DeFi on Ethereum. It got to a point where it was just so expensive to me. So I started looking at other chains. So discovered Polkadot and Kusama. Every other protocol there was doing liquid staking. So I was familiar with like Akala, Bifrost, and so on. And eventually I stumbled upon a friend of mine told me, look, there's this cool chain. It's super fast. It's super speedy, cheap to use. And they have 7 days left to apply for a hackathon. How about we apply? So we did. That was February 2021, the Solana Serum hackathon. And then throughout the hackathon, we learned a bunch of things about Solana. And we decided to give it a go to build the first ever liquid staking protocol on Solana, because that's what we knew as users. And out of Ethereum DeFi summer, that's what we were used to use. So we are thinking this is interesting to combine the concept of both staking, so adding to the network security, and at the same time having your stake liquid so that you can participate in DeFi. And that's how we kicked it off in a hackathon. It was supposed to be only a hackathon project, really, for us to learn and do something. And so we did learn. We were awarded, I think, third prize at that hackathon. And then we decided just to keep on building. It felt like we have something real. Tens of VCs tried to invest in Marinade. And then I didn't want to repeat the same mistakes I did with my previous projects. So we told to ourselves, this is going to be bootstrapped. This is Web3. This is a pretty special way how we can build things in this Web3 space. Let's just be honest with ourselves. And we had 6 months of runway, pretty much from Solana and Serum grant back then. And we decided to give it a go. At least we will know in 6 months if we can make it or not. So we started building. The community really got behind this idea of such an underdog. Like how could Marinade even beat this ETH giant like Lido coming from Ethereum, where also Lido wanted to acquire us from the very start. So that was it. We were set on this battle, and then we were happy to launch 2nd of August in 21 as the first ever liquid staking solution on Solana with mSOL. So that was the start of it.
Yeah, and I remember, so I joined Solana at the end of 2020, and one of the first kind of engineering type projects I worked on was with John building out the initial stake pool contract.
Yeah.
When you guys started, though, you weren't using what is now like the canonical Solana stake pool contract. You guys started actually building your own back in the hackathon, right?
Yeah, so initially, actually, we started using the original one, but after the hackathon, we decided to do some changes. So we wrote it to Anchor. We built like this unstaked liquidity pool to it. So you're right. We took the original code and forked it to adjust it. And what was funny that in summer 21, when the Neodyme, back then the Alice security team, they looked at both of the code bases and they found a critical bug in the original Solana code reference. And they gave us the green light looking at the Marinade code. So that's actually why we were lucky to launch as the first ones, because everyone else was just dependent on the original code. So that delayed them by a few months. So that's pretty much the story why we were able to launch first.
And what do you guys operate on now? Do you still maintain your own?
Yeah, it is still this one. So it has been audited by 3-4 firms up until this point, including the ones that audited the original stake pool. It's not like many changes to it, but we adapted it, pretty much rewrote it to Anchor and added some things that we felt like are needed in it. But the code hasn't really changed in the past 2 years or so.
I want to get into a bunch of the other stuff you talked on, but I want to hang on this for a minute because one of the core things with Solana is program reusability. For the most part, if there is a version of something Like on Ethereum, everyone, every time they deploy an NFT, is deploying a new contract on Ethereum to mint, then manage that NFT. On Solana, for example, you just hit up the NFT minting contract, and that's part of why things are much cheaper. But there's also kind of a component of maybe either shared security or shared risk, depending how you look at it. So I'm really curious. You guys, I think, are the only ones who run your own contract, as opposed to hitting up the main contract and then either bolting on additional components. Do you view that as kind of a advantage do you guys have? Like, why? I totally understand at the beginning why you might have moved in a different direction, but what to you as a core contributor has said, hey, we actually have reasons to maintain this as opposed to, migrate back to the other contract or something?
Yeah, I think the way to look at it is that it's been a smart contract running for around 4 years right now, managing more than $2 billion worth of Solana over time. So to us, I mean, if we look back, knowing how it's going to turn out, maybe we would have adapted at that time. It's just that the matter of the fact we rebuilt the code, which was audited with the green light, and then the other reference one wasn't. So just at that time, it was this decision to go fast and to do something, really. To go fast and safe, but to do something, really, not to be dependent on this third party trying to adjust everything. So it was a matter of speed and execution, really. That's why we started. And looking today, it is hard for us to imagine that how would we even merge back to their original code. There will be a lot of transition going in. mSOL is out there, it's used. So even if we export it with the Solana people, because we like that this is shared security, we like the concept, but we are beyond the point where just mSOL is so much used out there, it would be hard to imagine how we can revert back to the original code.
Yeah. So you mentioned at the early days, Lido tried to acquire you. The story of Lido on Solana is so interesting because you had this sort of very powerful incumbent that owned at the time functionally 100% of liquid staking on Ethereum. Now it's changed, right? You have Alluvial, you have other players now, but I think it's fair to say Lido is still the incumbent, if not one of the incumbent players in that space. They really struggled to get any adoption on Solana, where you saw Marinade take off, you saw a bunch of other stake pool solutions on Solana take off. But, I think for a lot of people, they were like, oh, this is just Lido's going to come in and roll over this market. Like, when you were sort of seeing Lido enter the market and sort of say, oh man, if we say no to selling to them, like we're going to have to go compete with them. Walk me through a little bit of that process and how you thought it was going to go versus how it ended up actually going.
Yeah, makes sense. So why we said no to Lido, along with tens of other VCs, was for us to make it hard and to maximize for learnings. That's what we want to get out of the hackathon, and that's what we want to get out of the 6-month period that led to, okay, are we building something or not? So we wanted to really maximize for learnings, and getting acquired by Lido or getting tons of VC funding was just not part of the equation. So we decided to try on our own. And then I think what mattered is that you cannot really clone what we're building at Marinade is very Solana specific, very Solana native. So it is the same answer we give out there. Why don't we go with Marinade cross-chain? And we have never ever tried it, and we have no intent to do it, because what we're building is just so specific to Solana. And I think we witnessed with Lido, you cannot just clone something that's working elsewhere and imagine that you are going to dominate other chains. So we felt like we have a big chance here, as long as the community understands this story, that we are building it with the community from the ground up, that we are truly decentralizing the network. Like, unlike Lido, which only took the biggest validators from Ethereum to Solana, Marinade actually skipped the biggest and diversified into hundreds of the community-run validators. So I think that's what mattered, that the ecosystem in here in Solana understood the mission, understood the story, and got behind the narrative. I think it's because of them that we were able to not push Lido back to the origins, but it was the result of it that Marinade won in this head-to-head battle, so to say.
Yeah, so if you go to where we are today, the staking landscape is extremely different on Solana, in part because the economics are quite different. You go back to 2021, 2022, there was effectively zero rev on Solana. It was all pretty much inflation and a little bit of block rewards. things, it's not, inflation still is the single largest group of rewards on Solana, but it changes, and there's moments where, other sources of revenue eclipse it, like during the Trump airdrop or something along those lines. But there's a huge number of other economics that have changed. Stake-weighted QoS has really upshifted the landscape from a place where validators, saw themselves as primarily providing a compute service to now they actually play a critical role in transaction delivery. And that's become an additional revenue source for a lot of validators. We've talked to a bunch that have arrangements with RPC providers where they're getting paid to have access to stake-weighted QoS. At the same time, you have other folks who are sort of operating alternative shred delivery services now on validators that bypass Turbine. The landscape's quite different than it was back in 2021. So I want to kind of go through a little bit of that history and how a stake pool actually responds to all these different types of economic changes. Has this been a benefit for you guys? Is it more complicated? Like, walk me through a little bit of how your business thinking has changed over the last 3 years.
Totally. So I think initially at the very start, it was easy, like you said. Even us, Marinade started with mSOL, so you could both get the staking yield. You can participate in DeFi. And the DeFi, the yield, that was, I would say, the majority of it, why people would go into liquid staking at the very start. I think fast forward today, it's not mSOL anymore. It's tens, if not hundreds of LSTs out there on the network. Of total, still growing, but 10% of a market share of Solana staking as a whole. So we're seeing roughly 10% split between LSTs, 90% into native staking. And when it comes to rev and this economic activity, absolutely. So around 2 years ago, actually, we started to coming maybe back to the drawing board and discussing, okay, why cannot we grow beyond that point? Because Marinade grew from 0 to 8 million Solana TVL in a few months and then stalled for a while. So, and we discussed, okay, why is that? Is that the smart contract risk? Is that the tax trigger out there? What is it? Why people are still preferring the native staking? And one part of it was also the yield, given that all stake pools pretty much charge a fee on top of the index of the validators in them. So it's like double the fee. If you stack up the fees together, you are getting lower yield than if you go directly to one validator or to the lowest commission validators in the network. So while Marinade was diversifying stake across hundreds of validators, and it's a great public good tooling to decentralize the network, we were not delivering the best yield out there. And we learned that that might be actually the ceiling on our growth, given that some people just prefer, obviously, more yield than less yield. And a lot of it came in with regular economical activity. So at one point, the transaction fees and MEV came in the past 2 years through the roof. So then we had another commission. So there is now MEV commission on top of the inflation commission. Then you have the priority fees, the transaction rewards, which could not be shared with the stakers in a native way. Yep. You have exactly the stake-weighted QoS. You have maybe the governance power on your staking. You have many different things that are benefit to you as a validator from that stake. What's unfortunate is that the whole staking market got extremely hazy and untransparent because no one could tell, maybe just the validators, but the stakers could not tell at all what's in it for them, really what's their true part of the whole pie and what's left by the validators. So if you think about it, there was a commission on inflation and MEV, and that's it. At one point, there was 1.5% of APY annualized just through block rewards, which were not shared, are not shared with stakers. So that was the turning point, I think, for us at Marinade, when we started to discuss, okay, what do we do with this? Because these deals where the staker would get the fair cut would only be reserved to this VIP staking market. So the biggest Solana holders and the biggest Solana validators would come together through off-chain agreement most of the time. And then they would enter agreement of doing additional rev share, lower commission, so they would get better rates than what's visible out there on public. And that got us thinking, isn't there a way how this can be democratized to the Solana network out there? And can we build something that will be more visible, more transparent for the ecosystem? Can we actually build a marketplace between the validators and the stakers? And that's what we eventually did.
Yeah. How do you view, I mean, nowadays, most of the validators' earnings for the sophisticated actors come from, I would say, non-on-chain revenue sources. Jito obviously is a good component. Block rewards are some component, but in talking with a lot of validators, the more sophisticated ones have larger off-chain deals than on-chain deals, unless they're sort of in the top, 20 in terms of size.
Mm-hmm.
How do you think about that from a Marinade perspective? Because you don't have, as you're saying, these are not deals you have transparent insight into.
Correct. Yeah. The way how we thought about it and then how we built Marinade from the start is that it's an open permissionless system, and validators, as long as they are performing, as long as they have great economics, they would get automatically staked from Marinade. That's how it all started. And you would need to be geographically diversified and whatnot. So there were a bunch of scores, making sure that the stake is spread across multiple different factors. Then at one point, we realized that it's a great open permissionless system, but at the same time, you are going to have bad actors in it. So for example, there used to be validators that would change the commission to 100%, and then they would up it up. So those commission rates were pretty standard at the time. You would have validators just with downtime. So you don't know the counterparty in our system like Marinade. So you cannot really do SLAs with them off chain and making sure they are going to pay for any downtime. So that got us thinking, how could we make this better? And we came up with a system called like protected staking rewards, which now requires validators to put up a bond, which serves like a collateral. And this collateral is used in the Marinade system to make sure that the validator is going to deliver. So even if we don't know who is on the other side with the Marinade general system, there is this collateral, this bond, so that in case they go offline, in case they try to spike commissions, or right now, if they are malicious with sandwiching transactions, they are slashed. So there is financial disincentive to those validators participating in the Marinade ecosystem. And that's how we got beyond making sure that there is a skin in the game from the validator side.
Yeah, how is that process? I'm guessing that was a pretty contentious rollout for them. Validators tend to, a lot of them tend to run pretty lean businesses. So I'm guessing it's the bond is proportional to the stake on the node. How did that process work? How do you handle things like top-ups? Like these are kind of like opsy questions, but like I think this is a little bit of like where you separate something from someone who's like running an institutional focused business from like, a hobby stake pool.
Right. Yeah, you're right. It was super interesting. At the very start, we just told them, look, actually majority of you validators are running fine, are performant. We do this for the minority of the bad actors that have wrong performance or malicious intent. So we roll it out, and the validators community participating in Marinade actually understood it. Because it was only to make sure that we deliver the yield expected. So what PSR did really is making sure that they are going to deliver on the yield that they promised. So the ratio is about 1 Solana per 1,000 staked SOL. So, and it is for the system to cover even the incidents as if the validator goes just completely offline. And then the Marinade system needs to redelegate that stake. So the biggest pain in the Marinade system I would say since history has been that the stake is moving. If the stake is moving, it's unproductive. You have 0% yield on it at that time. And as Marinade system is automatically moving it around, it needs to mitigate these costs of moving stake because that's reflected on the end user yield. So that's the bond basically serves to make sure that also covers this stake movement between the validators. So I think they got it well. And they adjusted, and looking at right now the numbers, more than 300 validators have the bond set up. They are participating in the system. So I would say it is working.
So you guys, there's two other pieces I want to talk about before we get to like ETFs and institutions. One is you have a non-stake pool product that you guys also run, which I believe is called Marinade Native. That does something pretty different. That is a native staking distribution. So I imagine this is for folks who don't either need the liquidity or are concerned about the smart contract risk of a stake pool. Like, walk us through kind of how that works. Like, how do you monetize something like that? And sort of what are the type of people who are attracted to that compared to either staking directly to a validator normally or going through an LST product?
Right. So back in 23, that was a time when we scratched our heads thinking, why is not mSOL growing further? Why is not liquid staking growing further? I mean, the adoption overall. And we got some great answers talking to the customers out there why they still prefer to do native staking. And even today, like I said, 90% of them would prefer native staking. So there's the reason. And even if we look at on-chain data, how LSTs are used, even today, most of them are not even deployed in DeFi. They are just held on wallets. So for us, the number one reason for LSTs today, it's actually not DeFi. It's much more this instant liquidity. If you want to get out of it, you don't need to wait those 2 days on staking periods. So then we thought to ourselves, okay, how can we bring the same value as mSOL was doing, diversifying the stake, but without the smart contract risk? Because the smart contract risk and this lost custody in some sense was the number one reason why people didn't want to use mSOL at that time. And we look at actually the Solana staking in the core protocol and understood this beautiful thing that there are the withdrawal authority and the stake authority. So there is actually a separation of powers already built in the Solana protocol as it is. So you can leave the users with the withdrawal authority, which is the master authority that gets the custody and ownership of Solana. And you can actually delegate the stake authority to someone else or a program. And that's how Marinade Native was built. So it's built on top of this separation of powers, where the users get to choose the Marinade system to be the automating for their Solana stake, while keeping full custody of their tokens. So the way it works, it's basically splitting your stake account into, let's say, 100 pieces. You see it at all times on your wallet. At all times, you can revoke it. And the only thing it can split and merge and delegate the stake accounts. So that was our aha moment. And we realized, okay, wait a second, this is interesting. So we can decentralize Solana through other means than just mSOL or liquid staking solutions. So this is getting interesting. And how do we pretty much build on top of this aha moment was what's in the next 2 years ahead of us.
So if we fast forward a bit to the current world of both ETFs and DATs, where do you think liquid staking factors in? There's sort of been, I think, from the SEC, the idea of a non-staked ETF. Like at this point, these things are very clearly commodities. Putting them into an ETF seems to make a lot of sense, just like any other commodity. They've been a little bit less. They've been a little less hesitant to a little more hesitant to approve staked ETFs. But there's been some talk now with Lido specifically of a mSOL ETF. So it seems like the space is moving pretty quickly. What's your sense of the role for both LSTs in ETFs and then in the digital asset treasury world as well?
Yeah, so great question. And I think we looked at the ETF space around the year, 2 years ago, looking, okay, what's ahead of us? And because what we saw was 6% of Bitcoin in ETFs, 3% of ETH supply in ETFs. So it's going to happen at some point to Solana. And if it happens, it is great for adoption. It's also this like centralization issue or a risk to some extent if all that inflows end up in a few custodians or on a few validators. Let's call it like that. So we realized, okay, we want to be part of this. That's why a year ago we brought on board Fidelity, BNYM people to join Marinade and helping us understand what it takes to build, to regroup something that was built truly for DeFi and retail and how to package it, how to make sure that we stand up as a viable option for the ETF issuers out there. And fast forward today, it's now integrated in BitGo, Copper Zodia, picked by Canary Capital. So it seems at least we are an option. And we think about Marinade Native integrated in those options as a way for the community, smaller relators, to get an option to play as part of the ETFs, because otherwise that would usually be the biggest validators only. So, and when it comes to LSTs, like to answer the question, initially we were extremely bullish on the concept. That's why we started with mSOL. Why we transitioned 2 years ago to native is just this understanding that Solana has delegation built in. You can click a button and you delegate your Solana without any smart contract, as little as 1 Solana, and you're done. So this concept of LSTs, it's absolutely needed on something like Ethereum for ETFs to be viable with staking. Otherwise, I cannot imagine waiting unknown withdrawal periods without that. So I absolutely get it there. On Solana, I'm a bit more hesitant, as you have 2-day withdrawal period. You have other ways how to go about instant unstaking. You have RFQ systems. You have market makers in between. So we are yet to see how those funds are structured. We welcome all kinds of various ways how to do it. Just our choice a year ago was that we are going to go with more security, more safety, and less risk. And that's why we went through SOC 2. That's why we went with BitGo, with compliance program, with even having KYC validators in Marinade. And this is all package that we are now showing out there to the institutions and see like this resonates with them because they get to diversify their stake across many validators, but at the same time, they don't lose custody and they keep the same safety as they are used to with native staking.
You know, you mentioned something there that's very funny, right? Like SOC 2 compliance for a validator. Staking is non-custodial, right? We all know this, that a validator can't actually steal your keys because those are held with you. And in delegation, now, if you're talking about a smart contract liquid stake program, maybe that's a little bit different. But even in that situation, SOC 2 is not about code audit, really. So you've obviously had to deal with a bunch of these requests that come in from traditional institutions that don't understand crypto, where there's just a compliance lawyer somewhere saying, hey, is this server SOC 2 compliant? And you're like, this doesn't even apply to me, but sure, I'll go get the certificate.
Right.
Like, walk me through a little bit of like the culture clash there, and like how much of these security procedures that you are being asked to go through by a DAT or by an ETF do you think is substantive or simply more of like a paper process?
So yeah, great questions, many things in it. So I'll try to cover it by part. So Marinade was, I think, the smallest company. The auditor told us that we are the smallest company to go through the SOC 2 audit ruling. Why we went through it, and it was actually helpful to us. Even at the very start, we were thinking it's going to be a check mark on the due diligence of the ETF issuers, because that's just how it works. The biggest ones, they are just going with SOC 2 validators. It gives them, it's not everything that they get out of them, but it's one take on the checkbox. And it's pretty much, they are used to from it on Ethereum, because again, the model is different than to Solana. So it's about safety, operations, data management.
Just to double click on that, like you are trusting the Lido operators because they do have the ability to run away with your Ether because there's no native delegation on Ethereum. On Solana, you don't have to do that because there is native protocol delegation.
Correct. Yeah, correct. So, for example, unlike with LSTs, where, as you said, you still have a smart contract, that smart contract still has some management. So institution is going to ask, okay, who owns the upgrade keys to the smart contract? And okay, how that can happen, or is it immutable? So those are some of the questions that the institution might ask. When it comes to native staking on Solana, the bare minimum still, why SOC 2 might be viable, is the operational security standards followers by validators so that they understand the security of their own system, the hardware setup, and so on. Again, with Marinade, as we don't run a validator, we are like an abstraction layer. We are a marketplace on top of the validators. Many of the things just didn't apply to us. So we went through the SOC 2 process, understanding that we don't store any of the user data. We don't run any hardware. So it was very minimal. And we ended up getting the type 1, type 2. And it was a process. It was quite something, but we ended up well. And at the end of the day, some things were helpful to us when it comes to security management on GitHub and so on. So I cannot say that all of that was a waste of time.
Do you think those levels of security assurance should be more common in the non-institutional side of crypto? Like, do you think it's like, obviously there is some value for you, you mentioned going through it, but like at the end of the day, should we be asking Phantom and Helios and Triton and Jupiter to be SOC 2 compliant at this point with the level that crypto's gotten to? Or is this the type of thing where it really feels like a legacy system that maybe is not meaningless, but is not substantively delivering security?
Yeah, great question. And exactly, because it's such a costly thing. So imagine that hundreds of validators on Solana, especially the community ones, can go through something like this. It's insane. Right. And that's why around 6 months, 9 months ago, we partner up with Alluvial on the node operator risk system, basically from Ethereum, and are adapting it to Solana. So the way it works is that we have this risk assessment, we have this compliance check-in, and all the operators that are getting in this program are actually vetted by external like EY, Deloitte, and so on, PwC. So you have external vetters of them, but it's much more lightweight than the whole SOC 2 process. And it's adapted to this Web3 world that we live in. So it is something usable. It's something that we can use as an assessment, who operates well and who doesn't. At the same time, it's something that's not as costly as the SOC 2 process. So it's something that we are rolling out together with Alluvial on Solana.
So I want to shift a little bit. We've talked a bunch about like the security of like the software and the smart contract side. There's a whole separate component, which is the type of transactions that are flowing over a blockchain. And the way blockchains are built, usually the block builder is a complete dictator. It has the right to include anything it wants in a block. It could put nothing in a block. It could put hello world in a block, or it could order transactions by fees. It could order transactions by who sent the transaction, if it's run by a trading firm. And this opens up all sorts of both good and bad systems. One of the things that, especially about a year ago, was a very big concern in the Solana community was the prevalence of sandwich attacks. These are basically where a trader has insights into what is about to happen on the market, either because they're looking at trades as they come in, or they have some other type of intelligence, and they're sending a trade to change a market price before a user can trade, to move the price in a certain direction, and then they capitalize on that price movement with a trade following. This got to the point where Jito actually shut down the mempool that they were running as a way to sort of help mitigate some of this. We saw the Solana Foundation dequalify a bunch of validators from its delegation program, which is a totally optional program, but to remove them from that program because of some of these activities. We have, I think sandwich.me is the name of the website now that sort of tracks globally how this works. This controversy hit a number of different node operators and liquid stake providers, including Marinade. How did you guys initially think about sandwiching and respond to it? And what's kind of the state of that now in how you take that into account or don't take that into account in where you choose to delegate stake that's deposited into Marinade?
Right. So yeah, you are right. The origins of that story was, if we put ourselves back in summer 24, that was the time when Marinade launched a system called Stake Auction Marketplace, which pretty much for the first time ever let the validators compete for stake in the open. So up until that point, validators could do commissions to zero on MEV, on inflation, but there was no way for the validators to share block rewards or to share any of the other upside. So initially we were thinking, okay, let them bid in the open, let them bid as how much they feel like that the stake is worth to the validators, and market is going to sort it out so that the validators can share the block rewards, they can share the SWQS benefits, the governance benefits at times when the votes are out there. There was just so many things to the validators that make benefit to the stake, and we were like, okay, let's put it in a single number. That's going to be the bid. So we made this auction summer last year, and realized over time that it was working. So up until this point, Marinade's yield was consistently beating any other validator out there on the network. So the yield is better than just 0% fee validator out there. That is true. But we were asking and we were curious, okay, how come, where the yield is coming from? And part of it, as we were talking about, could be the priority fees. So that used to be around 1% of annualized yield. So that would be understandable. But at some point, we got validators that were bidding upwards to 20% IPY in the auction. And then got us thinking, okay, what is that? What's going on here? And it is pretty hard to tell who doesn't like math and who cannot run the numbers, and then who is doing something intentionally malicious. So it took us quite some time to monitor and observe the situation. As you said, the MBV engine shut down spring last year. And then later on that year, we actually saw it didn't quite solve the situation. the sandwich rate, the volume through sandwiching only increased. And not only that, it got centralized in a few actors only. So instead of being at least distributed out there to all validators participating like it was before through the MEV engine, right now it became concentrated. So at that point, it was fall, winter 24. We put out a statement that we feel like that this is still a problem. It's out there. We feel that MEV, it most likely cannot be killed to zero. It can be mitigated, and what cannot be mitigated should be at least distributed. That's our stance on MEV overall. And we realized that the Marinade Stake Auction Marketplace is pretty much the only system out there that captures some of that MEV and puts it back on stakers, if you like it or not. So there were other pools or the Solana program that were attacked through the same malicious actors in the ecosystem, and they captured it all. While at least with Marinade, one way to look at it is that they would bid each other. So then some of that yield that they would be capturing 100% elsewhere was at least returned back to stakers. We were not happy about it, but that was the state of it. And as we transitioned into early 25, I think the situation quite changed, especially from the tooling and data perspective, because in 24, everyone was just blind and there was no way how to spot the malicious actors. And the way you spotted them and you had methodology, they would change. And early 25, with the help of the Ghost team and doing the Sandwich Me, that helped us understand the situation. And at one point, it got pretty serious. So we saw that, for example, in the mSOL Marinade pool, there were more than 50% of the stake pretty much captured by those malicious parties. So that got to a point where we are thinking, okay, this doesn't look like that Solana fixes this itself. This doesn't look like that the RPCs, we were in touch with some of the RPC providers to implement block list. We were in touch with the dApps on Solana, again, to implement something that would avoid deal flow to those malicious validators. So then they would end up with no transactions, making sure that they cannot even participate in the auction. We were hopeful there for a long, long time, but the results didn't really come. So the DAO decided to put up a proposal and start blacklisting the validators that are participating in those malicious activities. So there were a bunch of waves and block lists in the Marinade program. And the latest one was interesting because in one epoch, around 6 million Solana TVL in Marinade got blacklisted and got moved to other validators that were running the healthy, normal MEV. And the users wouldn't even feel this movement because all the malicious validators were slashed. The bonds I was talking about were slashed. So Marinade right now is the only system that disincentivize participating in malicious MEV activities because, again, validators have some skin in the game. They have this bond. And if they misbehave, which we can tell right now with the data, finally, thanks to the community and ecosystem builders, they are slashed. So there is this financial disincentive for them to participate in Marinade, and which shows right now. So right now, we see less than 100K Solana TVL in the Marinade products altogether that would be attributed to those random exploiting validators.
Yeah, how do you think about attribution there? Because validators, they don't necessarily have control of what transactions they process. Sometimes they do, right? They're intentionally hooking up to a relay that is engaging in parasitic MEV, or maybe they're not aware of it, but they haven't done any diligence on the relay they're hooking up to, which, a sin of omission is still a sin. So how do you think about the level at which that goes from something that is like, someone just optimistically ran a sandwich attack through a public RPC flow versus like, okay, this seems like it's a coordinated activity. Where do you guys kind of draw the line with that?
Yeah, I think where we ended up was looking at pretty much two numbers in it. One was the absolute number of the blocks with a sandwich transaction in it. That was one optics. Another one was the sandwich rate. So how many of the blocks of the validators include a sandwich transaction compared to the total blocks of that validator? And at times it is pretty obvious when you look at the cluster average of having, say, 3-4% of having the, say, median sandwich rate transactions, then it's pretty obvious to spot the outliers having upwards of 20-30% plus of their blocks. including sandwich transactions. So that's the latest data. To tell the truth, though, it's constantly evolving. So it's constantly this cat and mouse game. So even if the researchers came up with the methodology, the moment they publish it, that's the moment the bad actors adapt. So while I'm not a big fan, not super bullish on solving this in the short term, I think that something needs to happen in the Solana protocol as it is, like multiple concurrent proposal leaders and so on. So that's where we are. It's still adaptive, so it's hard to tell the data if the data are truly honest with us and how to go about it, because the actors just adapt.
It's just something you can minimize. It's not really a solvable problem. Just sort of like these blockchains that are like, we've solved MEV. And it's like, no, you haven't solved MEV. You've just moved it somewhere else.
Yeah, correct.
So, yeah. So what do you sort of see as the future of these? What does the expansion look like from here? I know you mentioned you guys have no interest in moving out of Solana, but what does that growth path kind of look like?
Right. So, I mean, we've been building the past 12 months, making sure that we get to play on this institutional level. So we feel like we are slowly growing up out of where we started, which was mSOL and was serving people in the Marinade web app, which is beautiful. Where we're heading next is making sure that even institutions can stake in a responsible way. So that's what we are right now after, and especially this month, with hopefully ETF playing out and big institutions coming and leveraging Solana network, we feel like a system where they can distribute the stake across many validators is still going to be helpful and needed to make sure that the network is still safe and secure and decentralized over time. So we'll be in more, I think, qualified custodians over time. We'll be in more places that feel natural to people to stake their Solana, because most of the time that is not the Marinade web app. It's elsewhere. It's the wallets, exchanges, custodians. So we are working a lot to make sure Marinade is an option there. And what's also coming next is that we understood that the way the Marinade strategy is set out, it's very prescriptive, it's very opinionated, and there are many different people with many different flavors, to put it like that. So it might be that for the users, they just want more expressivity in how they're staking, because it's not only the best yield. At times, people are staking to their favorite brand, or they are staking to 0.0 validators because they believe in the cause. So that's something we are looking into right now, making sure that people can express themselves in the way how they delegate their Solana. So soon, you can imagine that even through the Marinade web app, you will be able to stake, for example, to only 0.0 validators in one click, and without a smart contract risk through native staking. And we feel like exploring this option for people to manage the different staking strategies out there. So that's kind of where we headed. And that's also what we understood from the high-level ETF market, is that Marinade Select, which has KYC validators, is a great start, but they might want to go with, again, the SOC 2 geographically diversified validators. So Marinade is going to allow them to do just that with on-chain bonds put in it and all the security we were talking about that we already leverage in the Marinade system.
Well, if folks are interested in learning more, getting into your validator pool, where can they sort of learn more about Marinade and get involved?
Right. So start at marinade.finance. We are on X. We are on Discord. So happy to help there, chat more there. docs.marinade.finance would be for the validators who wanted to learn more about how to get in, how the auction works. And yeah, we can take it from there.
Awesome. Well, thanks for joining us today on Validated.
Thank you very much for having me, Elsta.